the main difference between asset management and capital planning is that asset management is kind of an overall look at your infrastructure and how to get the most useful life out of it, and capital planning is a document that will help you pay to replace it when it needs to be replaced. And I think really that gets to the question of what's the risk of not doing this. I don't care how good we are at managing our infrastructure, something that goes in new will in 10 years or 30 years or 60 years need to be replaced. Everything is going to wear out no matter how good of a job we do at maintenance and how good of a job we do at repairs over time. It will need to be replaced, and when it needs to be replaced, are we ready to replace it? Are we anticipating it? And do we have the money to fix it? And are we keeping infrastructure in a good shape so that way we're doing more scheduled preventative maintenance and less kind of reactive emergency maintenance?
All right, this time we'll remind everybody to please submit your questions in the questions box. We did get a question coming in that's related to this. So Glenn, the question came in asking if there are any good resources that could help users or help systems figure out what the average useful life is for certain types of assets, certain classes of assets. So how long will pipes last? How long will machinery last? And how they'd be able to determine how long their particular assets might last.
Yeah, this is a really great question. So thank you, Gary, for sending it in. I think the answer is yes, there are engineering guides. Maybe when we send out the final presentation, we could put a link to one in there that we have that will give you a general sense of how long different types of assets will last. And obviously, pipe is not just pipe. It's going to be a difference between PVC pipe versus cast iron versus AC pipe, et cetera. But I do want to emphasize that the local conditions have a lot to do with this. So soil conditions, earthquake activity, seismic activity can have a lot to do with it. Presence of salt water in the area can have a lot to do with it. And then it's still a best guess. So if that, it's assuming the pipe is put in properly, it's assuming that it's been maintained properly over time. And I think the idea of asset management is that it will eventually lead you to better preventative maintenance, and you may find that you can extend the useful life of assets. But Gary, just to answer your question, there are some guides out there. I think most of them are freely available, or at least some of them are freely available, and we'll include some links in the final presentation.
Right. I remember there's at least one EPA guide and maybe one AWA guide, and they provide very, very basic rules of thumb for different classes of assets. But like Glenn said, the local conditions really affect what those numbers are. I'll tell you, we'll provide that, we'll add that slide to the slide deck that shows what those the classes lifetime are. In general, EPA was recommending something like 50 years for pipes, 20 years for machinery or anything that's moving equipment. But again, it really does depend on your system and how often you use your assets. If you're not using your pipes as much, they could last 100 years. So those are the two kind of starting points: 20 years for 15 to 20 years for moving parts, and then 50 years for something that's longer structurally.
Okay. Next question for you, Shadi. What is the best way to budget for capital planning?
All right. So I think that the best way to do budgeting for capital planning is to start with a capital improvement plan. So Glenn has already explained asset management planning and capital improvement planning. Really, the ideal way is you have an idea, you have a sense of what your capital projects need to be first. You price them out using consulting, engineering firms or your internal assessment. Figuring out what your capital projects are, how much they're going to cost. The next step is to identify how you're going to be able to pay for those costs. So you might know that in 2 years' time you're going to have $1 million of capital projects. Are you going to pay for all of that in cash, or are you going to pay for some of that using long-term debt? Having some idea of what those funding scenarios or how you're going to be able to pay for those capital projects will then help you figure out how much money you need to start saving today to meet those goals in a year or 2 years' time. So start with the capital improvement plan, break down those costs, figure out how you're going to pay for them, and then work backwards and fit them into your budget for the next coming year. That is really the ideal way. Now, if you're a water system that does not have a budget or capital improvement plan, and you have just very few assets and you're not too concerned about doing a 20-year or 50-year asset management plan, a second way to do it would be to try to at least fund your depreciation values. And Glenn has done a webinar a few months ago on depreciation and how you can use depreciation for capital planning purposes. There are a lot of caveats with using depreciation. It's not an ideal measure of budgeting for capital projects, but it is a helpful surrogate for a system that does not have a capital improvement plan, that does not know what the numbers will look like going forward. So those are the two. The worst way that you could do capital planning or capital budgeting is to not budget at all and to just wait for something to break and then try to figure out how you're going to pay for it. We know there are some systems, unfortunately, that are in that kind of position. That is, the way that you want to try to avoid.
Okay. And Shadi, a related question that came in, so wells cost millions of dollars, water infrastructure we know is very expensive. How do I raise rates for reserves to pay for capital when my operation and maintenance expenses are also increasing?
We hear you, and we know that this is a very difficult issue that utilities are facing. In particular, I think that, we know that rates are going up. In general, water and sewer rates are going up faster than inflation, about twice the rate of inflation of consumer goods. So rates are going up quickly already. Adding on top of that, if you haven't been doing capital planning and then you start doing it and you realize that you have a lot of costs that are coming up and that you need to start saving for today, raising rates to accommodate for all of that is a very difficult thing for small systems in particular, because you don't have a huge customer base that you can spread those costs all over. So to answer this question, it comes down to first accepting the fact that, or accepting the idea, the principle that full cost recovery is a priority objective for your water system. If you don't believe that, then this question might be moot. But if you first have to acknowledge that, you want to achieve financial sustainability in the long term and full cost recovery. By acknowledging that and with the board's approval of that, then you can start looking at, raising the rates to the level that you need to be able to pay for your capital projects as well as your operations and maintenance. Here are some tips that might help. Do an annual review of your revenues and expenses and don't wait. Don't just do one and then wait several years before you review your revenues and expenses, because things will keep changing and you need to keep adjusting your rates. You might need to raise your rates every year, small amounts, as opposed to raising the rate, waiting for several years, and then having a very significant rate increase after a few years of not raising rates to kind of recoup or to recover some of those needed revenues. Don't underestimate your total costs. And one thing that we show is that even capital projects themselves, the construction costs that are the big, millions of dollars, the big sticker shock value, those things are not the only thing that you need to be worried about. When you have a capital project, you have the cost of the acquisition and the construction, which is a significant amount. But that's only a portion of what the long-term, the lifetime cost of that asset will be. You've got maintenance and operations of that asset for the next few years. You've got refurbishment or rehabilitation along the way as well. And then at the very end, you have some disposal costs. EPA has a while ago estimated that the construction cost, the acquisition costs, are about 35 to 40% of the lifetime of the life cycle cost of that asset. So keep that in mind as well. So we're talking not just the millions of dollars to install a well, but it's also more than that to be able to operate and maintain. So don't underestimate those costs and keep them in mind. If you think that it's too expensive to do everything at once, try phasing out some of your projects. Consider doing the rates analysis with a consultant, because they might have some tips about how you could adjust your projects and adjust your costs. They might have some ideas of how to do some of the projects less expensively. Always ask yourself, do you really need to do an expansion? Even if you have access to grants or to low-interest loans, does not mean that you necessarily have to do an expansion, because we've seen that demand projections water use has been declining for a lot of systems. So always be asking that question about whether or not you need to expand your system.
And I'll just say real quick to add on to that, especially if you're looking at expanding the capacity of the system, please do a water loss audit first and address your non-revenue water issues before looking at system expansion. We've got a lot of good resources on that as well.
And that will save you on the operations and maintenance costs as well. So that is a key tip right there. The last suggestion I have is to consider doing regional projects as much as possible to try to share those big capital costs among multiple systems, among lots of customers, as opposed to doing everything independently and incurring all of those costs at the utility level. So that's one way to keep your costs low or spread them out over multiple people. I'll give you a quick, you don't need to take a look in detail about this graph, but I just want to let you know that the construction costs are going up by about 3% per year, about 2.5% per year. So, keep that in mind too, that the longer that you push back some of the projects, those kind of capital costs might be going up over time as well. So that's just something for you to know and to be aware of as you're budgeting and thinking long term.
All right, great. Thank you, Shadi.
All right, Glenn. So we're just talking a lot about replacement costs. Where can I find information about replacement costs of assets?
Yeah, this was a great question that somebody submitted for us that we wanted to address. And so I think we have a couple of pieces of advice. I mean, I think the first thing I just want to stress is there's no easy, website that you can go to that EPA maintains that just has the prices of what to expect to pay for things. It's really going to be tied to individual vendors. And so our advice is shop around. You probably have vendors that you've worked with in your water system. Talk to them, talk to others, and especially if you're going to be doing a long-term capital improvement plan, you might want to share that with them as well, because there may be some opportunities for volume discount if you're able to secure somebody for multiple projects instead of just one. But beyond talking to vendors, I would also really recommend talking to other water systems. If you go to conferences or go to trainings, please bring business cards and trade them and keep these people's phone numbers and email addresses around. I've never met a water system that's not happy to talk to another water system about what they're doing. They may have found something that works particularly well. And then I think the last thing I would recommend is, look at your past costs. If you just had to replace a pump 2 years ago and you're having to replace a similar size pump today, the price is probably not significantly different. Shadi just had the slide up about inflation, so keep in mind there will be a little bit of an increase perhaps in the price, but looking at your past expenses could be a good way. That being said, obviously, if the last time you replaced, pipe was 20 years ago, you're going to see a pretty significant difference in the price today. So these are some of the suggestions that we have. If anybody is aware of a good national repository of prices or a guide that kind of gives, price ranges of things, please let us know either through the chat box or email us, and we'll be happy to send that along as well.
Yeah, in particular, any resources that might be not national in scope, but also regional, so they have some cost differences for different regions of the country. Something, Glenn, that you mentioned that I think relates to a previous question. You mentioned calling the vendor and finding out what the prices of assets are. Going back to that question of estimating what the life, how long an asset is supposed to last, call the vendors, call the construction firms that put these assets in place, because they'll have some estimates of how long those assets will last. So that is another resource for you there.
Okay, great. Just a reminder, please continue to submit questions to us. We've got a bunch here that we've got to get through, but again, just use that questions box and we'll should have time to get to it during the hour. Okay, so next question, Shadi. How much should a small water system set aside in reserves, and are there limits on cash reserves?
All right. So we get that question a lot, especially for small water systems that know that they have significant capital expenses coming up, and they want to start saving money, saving for not just for the debt service, but also to pay for some of these projects in cash. there's a difference between local governments and privately owned systems, or systems that might be regulated by utilities commissions, and we'll come to some of those. The answer to the direct question about how much do you need in reserves is not the best answer in the world, but it depends. There is no single rule of thumb that applies to everybody. No size fits all. Different states have different requirements, different expectations. Different board members have different ideas of how much you can hold. There are some guidelines. There are some suggestions of what you could do. And here are three of them. And all three of them might work. You might need enough money in your reserves to be able to pay for your most expensive piece of equipment. So if your most expensive asset fails, let's say a well fails or a well pump fails that you're dependent on, and you need to replace it right away, you might not be able to wait until you secure a long-term, you secure a loan in order to start construction and to repair it. You might need to pay for everything up in cash. So have at least enough in your reserves to be able to cover the capital cost of replacing an asset, the most expensive asset in your system. That's a good starting point for a lot of systems that don't have a lot of assets and they don't have a lot of time to be doing a lot of planning. At least know that amount and set that money aside. Another way to look at it is you might want to reserve enough in your revenues that will cover operations and maintenance costs for a portion of a year or maybe even a full year. So if revenues are not coming in a very stable fashion, if you're let's say if you charge your customers every 2 months, so you're getting revenues, and you're charging them all at the same time. So you're getting every 2 months, you're getting a huge cash influx, and then in between those 2 months, you're not getting anything coming in. Having a reserve on hold that can cover your daily operations and maintenance costs in between those revenue, those collection periods will be helpful. So at least cover 1 or 2 months of your operations and maintenance costs within your revenue, within your reserves. We have seen utilities set financial policies that say we want to have in our reserves a minimum of X% of our annual operating expenses. And that X% is anything from 8% to 15%. Some utilities ask for 50%. We have seen utilities that say they want to have at least a year's worth of operations and maintenance costs set in reserves. And again, that comes down to the comfort level of your staff and of your board, of the decision makers. Are they okay with sitting on a year's worth of reserves and not spending it for other kind of purposes? The third guideline is to look at your capital improvement plan to know how much you're going to have to pay for capital projects going forward, and then use that as the way to determine how much you need to set in your reserve. So if you know you're going to have $1 million worth of cash and debt service coming in next year, you want to have at least $1 million in reserves. If you have long-term debt, then your debtors will also have some guidance about how much you need to set aside in your reserves as part of the debt service coverage ratio. So they'll ask for you to have enough revenues coming in to pay for principal, interest, and operation maintenance, and an additional 20 or 25% on top of that. So those are some guidelines that could help you assess. It's really difficult to give you a specific guideline because, like I said, every state has different numbers. And then keep in mind too, if you're regulated by a utility commission, if you're a privately owned system and you're regulated by a utility commission, there are some hard limits set by state law or practice about how much you could. So there are some maximums there. And it depends on how you're allowed to set your rate case and to determine what your rates are, and each state has their own rules and own process of calculating those. But note that for those cases, for regulated utilities, you can sometimes use depreciation as a way, as an expense, as an allowable expense for the utility. So you could be able to, generate the revenues to pay, to quote unquote pay for depreciation and set that money aside as a sort of a reserve.
Yeah, and just to stress there that utility commissions will often allow for a rate of return, and depreciation is not part of the rate of return profit, if you will, that's out there. So that's an additional way to get some money in. So we had an interesting question come in. Shadi and I are kind of staring at it like we're not quite sure maybe what the answer is, but I think it's a good question that James submitted. Just going back to our vendors for a second, what suggestions do we have about regarding minimizing or eliminating fraud, including kickbacks involving contractors, vendors, and consultants? And, this makes me think there's a credit card commercial that's out there now that's like, don't you wish everybody said what they meant? And there's a guy fixing the couple's kitchen, and he's like, well, we're going to run 6 months over. I'm going to, break something that I shouldn't and not tell you about it. And, all of this stuff. I mean, don't we wish that was the case? I think this is something that we see with a lot of systems is that sometimes, somebody's brother has a company or, whatever the case is. But, I think my suggestion, because my background is in public administration, is having a clearly defined procurement process that you have to follow in terms of selecting a vendor or a contractor is a way to start this, at least. So that way there's kind of a fair and honest looking at everything. I would certainly do reference checks on all of the vendors and contractors that you use. Ask them for other water systems they've worked with and take the time to give them calls. And, and of course that's going to be a little biased. They're not going to give you the one they cheated, and that's going to give them a bad review. But again, it's helpful, I think, to get out to conferences and trainings and talk about some of the vendors and your experiences. But it's a tough question. I don't know if I have better advice other than good procurement and do your homework about who you're going to be working with.
Sometimes the funding agencies would also know about the different firms, so they might be able to. You'll get the references from the firms who are bidding for projects that you could go talk to, but you can also ask different funding agencies about, are there other projects or what do you know of these companies? And what's the reputation and find out. I also, if anybody has on the call has a good suggestion, a good answer, please feel free to put it in the questions box and we'll read it out to the audience. So we're happy to share that. All right, Glenn. So talking about funding, what are some of the best practices and typical sources of funding for different kinds of components of water and wastewater systems?
Okay, yeah, thank you for this question. So what I want to start off by talking about is just in general what are the different ways in which we can pay for capital improvements. So, one is through your current receipts. You pay as you go. Money comes in the door every month or, every quarter for your water system. You have bills. As soon as the money comes in, you're paying it out. Obviously, we've been talking a little bit about reserves. Shadi was just talking about that. So you can save in advance and pay for infrastructure as it comes through. You can borrow money and pay later. So somebody will loan you money either through a traditional lender or through a lending program. And then obviously, they're fleeting, but there are some grants out there where you can let somebody else pay for you. And certainly we don't want to discourage you from realistically going after grants, but I don't think we'd be doing our job to not say on the webinar that, they are few and far between and that they're not a long-term solution for water systems. Everything else up here, you take the grants off of that, is your customer money. Whether you're paying as you go, you're saving in advance, or you're borrowing and paying later, it's all your customers' money. So to get at this question of kind of what are the ways to do this, I think it really gets down to, do you want to pay in cash for something or do you want to borrow for something? And a little bit later, we'll show you a link to a spreadsheet tool that we have for capital planning. And within that tool, we give you the option of either choosing to use your capital reserves or to use debt financing for the particular assets that you have. So you're going to want to have a mix of those two. Like that's kind of a best practice, is probably to have a mix of debt and cash. But I think if you are going to borrow money, and generally speaking, water infrastructure is a good thing to borrow money for because it has a long useful life. Do try to avoid borrowing money for longer than the useful life of the asset that you're replacing. The whole idea of borrowing money and paying it off over time is that this asset is going to last for many years. And so, you've got something like, say, pumps or motors that will probably last no more than 10 years. In some parts of the country, depending on your electric supply, it might be 2 years. Meters probably need to be changed on, 10 to 15-year basis. Hydrants, probably 20 years. Vehicles, certainly within a 10-year line. But then, up on the screen here, we also have storage tanks and wells and pipes that could easily last 30, 40, 50, 60 years or more. So if you're going to be borrowing money, a best practice is to really think about the expected useful life of what you're borrowing money for and try to match the debt to that expected useful life.
All right, so what are some of the best funding sources for privately owned systems? We usually talk a lot about local government systems and how they can source some or pay for some of the capital projects, but what are some particular ones for privately owned systems? And then which ones don't require personally guaranteeing loans? So, you don't want to take a credit card and just pay for things yourself.
Okay. Well, these were a couple of great questions that came in. I do want to point out that we have put together state by state a list of funding sources available for all water systems. So if you go to efcnetwork.org, our project website, and click on resources, under resources, you'll see funding sources by state, and then you'll get this lovely map of the U.S. Click on your state, and you will have a window pop up that will show you the different funding sources. And you can't see it on the screen here, but we also have the territories and the Navajo Nation links on there as well. And so these are all funding sources that are available for all types of water systems, including ones you'll be very familiar with, like the state revolving funds and USDA rural development and the community development block grants. So they're both a mix of grant funding and loan funding. But specifically for the question for privately owned systems, the rules are a little bit different state by state for some of those programs. So in some states, the drinking water SRF privately owned systems are eligible. In other states, they're not. Generally, they're not for USDA. And the way to get CDBG money is complicated, not impossible, but complicated. But there are a couple of other funding sources that we wanted to mention that are out there that you may not be as aware of. One is that there's a loan program operated by our colleagues at the National Rural Water Association that is non-governmental systems are eligible as long as they are nonprofit systems. However, if you are a for-profit system, you're not eligible. Then our friends at R.C.A.P. and their affiliated organizations have, some of them have lending programs. And so we talked with the representatives from some of those programs. One is Communities Unlimited. And they said private systems do qualify for the loan, and oftentimes that they will want hard collateral to secure the loan. And that may be the asset itself, but obviously there are some types of assets like, say, well or pipe, where it might be harder because you can't really repossess it very easily. And so they said it is true that in some cases a personal guarantee would be needed from the system owner. RCAC, another one of the R.C.A.P. affiliates, also says that private systems can qualify, and they have environmental infrastructure loans and small business loans that might also go for those privately owned systems. So they are often looking at collateral as well. And so the loans are generally not personally guaranteed. They want some kind of hard asset as collateral. So those are some options. And then the other group we wanted to mention is CoBank. CoBank is a nonprofit lender that specifically funds water and wastewater infrastructure and does a lot with small water systems. They are happy to do loans to private systems, but those loans need to be secured by either a mortgage on the assets or on the revenues of the system, and that they evaluate the collateral needs on a loan-by-loan basis, so it may or may not include a personal guarantee. So those are a couple of options out there that I think would at least give you an opportunity to see if there's something else available.
Thank you. And so those are all great funding sources. Going back to some of the other funding sources that Glenn mentioned earlier, like the USDA and CDBG, some of the funding sources that might be only limited to local governments or government-owned systems. Keep in mind, if you have a project that might be a regional project or where you might be able to partner with a local government, nearby local government, so that you both are sharing in that project, or your project is a subset of a larger project that the local government is doing, then the local government is eligible to apply for these low-interest loans and get them and be the ones that administer some of the funds to the private system on this regional project. So think about regionalizing your project with a neighboring local government as well, and see if that could be covered through some of these other sources that Glenn mentioned earlier.
All right. As a reminder, please continue to submit your questions and comments. We did have a comment from Sarah that I wanted to share on the vendors. She wanted to echo our suggestion of doing your homework and suggested to utilize your assistance agencies. Most of them are willing to help with the interview process, and especially on the engineering side. So I think that's some good advice as well. So certainly technical assistance providers. And I think, if you're dealing with, say, a state rural water chapter, for example, that works with dozens of utilities across the state, they may have heard some horror stories from some of their clients, and so if there's vendors as well, private vendors that you trust, that you work with, they may have some good intel as well to share. So thank you, Sarah, for that comment.
And just as a reminder, we're about 15 minutes from the end of this webinar time, so please submit your questions now, and we can queue them for the remaining 15 minutes.
All right, so Shadi, a question that came in, what types of demand forecasts do you recommend utilities use for capital planning?
All right, thank you. That's an excellent question, and I alluded to it a little bit earlier when I mentioned that we've looked at some of the demands, and we've seen that water demands have been decreasing for some utilities, which is why we're always recommending that systems think really hard about whether or not they need an expansion project, even though there may be funding available for it. So just to share some of those numbers with you, and some of the findings, this is coming from a blog post, some analysis that we've done a few years back now, but it's still relevant. We know across the country that average demands are decreasing. And that's happening across the board for the majority of systems. But we were also kind of slightly surprised, but maybe not too surprised, to find that we're starting to see a lot of water systems, in this case, a majority of water systems from a particular study from AWWA, show that their total demands have decreased, even though the number of customers have increased. So population is growing, but because average demands are decreasing over time, that decrease in average demand is compensating for the growth in population, and total demand decreases. So if a utility is not aware of this, if you bring it down to the local level, if you're not aware that your demands are decreasing over time, and you're assuming that you need an expansion project, you take on debt, you do the expansion project, you now have this new asset with a lot of capacity, you're paying for in debt, and it's an expensive piece of equipment, and you're having to pay operations and maintenance on top of that. And if your demand is decreasing, you're not going to be utilizing all that capacity. And not only that, but also your revenues might be decreasing because your usage decreases. So your revenues are going down, and now you've added a lot of additional fixed costs that you have to pay for. So that's really a very difficult situation. And there are unfortunately, lots of communities that have been in that kind of position in the past few years. So we're trying to recommend that you avoid doing that. So part of capital planning is not just looking at future capital projects and how much it's going to cost and how you're going to pay for them, but it's also look back and look at your long-term demand trends and determining going forward if what kind of demands are you going to be facing, and whether or not you need to look at different water supplies, different water sources. This is an example of what a demand chart looks like. This comes from Seattle. A lot of small systems can do very similar things. This is a graph that just shows the total demand, so million gallons per day, for Seattle since 1930 onward. And you can see between 1930 to 1985 or 1990, demand has been increasing linearly as population kept increasing. But then after 1990, demand has actually started decreasing. You see those dotted lines that go above? Those are what the projections were in those different years. So the first dotted line, the green line, it shows in 1967 that Seattle looked at the demand and said, oh, our demand is going to just shoot up and very quickly. That never actually happened. The blue line shows you what the actual demand was. So every year they were looking, or every few years they were looking at those demands and they were making projections. And those projections were a little too optimistic as far as how much water they're going to be selling. And demand was actually lower. So this shows you that this happens not just for small systems, it also happens for large systems, and how important it is to do these kind of assessments. So here are some guidelines about what you can do to assess your long-term demands. First, start with your historic data. Go back and find several years of your annual or your monthly records. If you don't have those records, keep those records. Start keeping those records. You need to have at least a good 10-year horizon to be able to make some good forecasts going forward, either at the annual level or at the monthly level. I recommend looking at multiple metrics, not just fixating on one. So this graph that we're showing from Seattle was just showing total production, million gallons per day. That's just one metric, and it's an important one. You do need to look at how much you're producing, and there's a difference between production and sales. How much you're producing is how much you're treating and putting into your distribution network. Sales is how much you're selling customers. So there's a difference between that, where you have some leaks or you have some unmetered accounts or water theft. So there's non-revenue water that happens in between production and sales. You need to look at both. You need to look at your production and you need to look at sales. You need to look at total demands, either in gallons, million gallons per day or gallons per day, and you need to look at your average production as well. So gallons per month per account. So if you have 100 households, divide your total production by those 100 households to get a monthly average demand per household. Or gallons per capita per day, if you have any good numbers on service population. And you need these two different things because you might find that your average production is decreasing over time, but your total production is increasing because your growth number of customers coming in are compensating for the reduction in average demand. So you need to know both. Also look at max day demands or focus on your peak months. The max day demands is an important one because it will help you determine what at what point will you be meeting your system capacity, and at what point do you need to start expanding. You don't expand based on what your average demands are going to be. You really expand based on near your max day. You might not be exactly at max day, but somewhere near the max day. Or focus on the peak month. If you're consistently selling most volumes in July, for example, then focus on your Julys and project those going forward. Break down your projections based on customer class. So look at your total demand across all sectors. And then if you do have good records on customers based on customer class, so residential versus non-residential or residential versus commercial versus industrial, then break those up and then calculate all the things I just mentioned for each of these. The more of these analyses you do, the bigger picture that you have in your head, and you can do some of these projections going forward to help adjust your rates for each of the customer classes. So there's also, keep in mind that you've got short-term forecasting and long-term forecasting. Short-term forecasting you do so that you could figure out how much you need to change your rates next year to get the revenues that you need to pay for your expenses. Long-term forecasting is to look really more at water supply issues and whether or not you're going to have enough supply to meet your demands, and at what point do you need an expansion. For short-term forecasting, you've got those numbers, you've got the 5-10 years worth of data looking at demands, annual demands or monthly demands. You can do a linear projection of demand going forward, or follow an appropriate trend line. If you're noticing that the long-term demands are not just growing linearly, but they're kind of decreasing slowly, kind of similar to, go back to Seattle's graph, you can see that in the 1980s, that linear line kind of slowed down a little bit. So adjust your demands based on what these lines look like. Pick the right shape of the forecast going forward. You could also weight the most recent years more heavily. So rely more on the most recent years and then rely less on the older years. Adjust your average. So once you have that kind of linear projection, maybe adjusted by the most recent years first, more so than the older years. Then, sit back and think about whether or not you have something that's going to happen in the next year or next few years that will adjust those demands. So you know that there's a new development in your community, or there's a new industry that's going to be moving into town, or you're losing an industry. And if you know those things, then factor those numbers in after you've done this projection. So you can adjust, you can bump up that line up and down. Also do it, should have said also adjust those demands based on prices. So if you're raising rates, we know we've analyzed it and we've looked at a lot of research that have shown that as rates go up, average demands go down, especially on the residential side. Rule of thumb is if your rates go up by about 10%, average demand for residential customers goes down by about 2 to 5%, depending on how much water they're currently using. If you're not selling a lot of water, if your customers are already efficient, it's closer to that 1% to 2% reduction for every 10% increase in rates. If you're selling a lot of water, if there are a lot of lawns out there that are irrigating, then for every 10% increase in your water and sewer rates, your average demand will go down by somewhere close to 5%. So those are rules of thumb to adjust your demand. And I mentioned looking at things that are changing, new customers coming in, or if you're going to be imposing conservation measures, factor those in your adjustment. Be conservative, because if you're doing short-term forecasting, you're doing it for revenue projections in particular. And with revenue projections, you always want to be very conservative and assume low water use. So that way, if you end up selling more, then that's a good thing. But if you don't get shortchanged if you're selling less water than you were expecting. For long-term forecasting, again, this is more focused on looking at water resources going forward. Estimate ranges instead of single values. Don't just look at one line. Talk about a line that has a lowest case scenario and a highest case scenario. So you have a range of projections going forward and work off of that. Adjust the average demands based on prices. If you know what your prices are going to be looking like, then adjust them using the same kind of threshold that we were talking about earlier. Similar, adjust based on interventions. If you know 5 years, 10 years from now, our land use projections are saying that we're going to have much more industry and less residential customers, then that should adjust your projections. Consult with your council, with your planners, to talk about those local projections on demographics or land use plans. So they'll have some information, or the council might know what their long-term vision is for your community, and you need to be able to factor that into your projections as well. And I'll be remiss to not mention, if you already have a water resources management plan, whether it's imposed by the state or you've done it yourself, then always go back to that and keep updating that assessment. I'll mention that there is a tool that was developed by the Alliance for Water Efficiency that's called Sales Forecasting and Rate Model. It's a free tool, and what that tool helps you make these kind of demand projections. And the way it works is you put in some historic data on your rates and on customer use, and some of your some temperature data and weather data, and it will simulate, and you can watch it happening live, multiple scenarios going forward where there are some dry years and some wet years, and it will at the end of its own assessment, it will give you that range of here's your projected demand, and it's going to show you a low case scenario and a high case scenario. So that's a tool that you could use that will automatically do these projections for you, and it's cool because you can then put in your rates, your current rates, as well as proposed new rates, and it will apply these demand projections on your rates to assess what your revenues will be going forward, as well as your expenses.
And we have a question from our friend Denise Schmidt. So from an engineer's perspective, conservative means assume high use so that there are no shortages.
Right.
How do you reconcile the financial and engineering perspectives on projecting demand?
Great question.
And you're sitting here with an engineer, Shadi, speaking, and a finance guy, Glenn, speaking.
Right.
So.
Yeah. No, when I say be conservative with your estimates, I laugh because I'm wearing both hats at the same time. So yes, with short-term projections, be conservative. Assume low use because you're focusing on finance. With long-term projections, you want to be focused on both. You want to focus on, again, still be conservative on the and low on the demands to assess financial projections being low, but also on the water supply side, resources side, you want to assume high demand because then that helps you think about an expansion sooner rather than later, but also be aware again that you don't over-project what your demands are. So that's where I mentioned you want, for long-term projections, you want a low and a high use scenario and not focus on only a single projection going forward. You want that range. And that's where that range is. You're going to have a low side for the financial projection and the high side for the water use projection. So you need both. And then kind of use your best judgment going forwards on what to do with that information. Hopefully it's not too wide of a gap. Okay, so let me ask you, Glenn, maybe this might be our last question. It's a question we always get, and we got submitted several times from registrants for this webinar. Are there some simple resources that can help water systems, particularly small water systems, get started and implement capital planning?
Yeah, so thank you for the people who submitted that question. There's a couple of tools we wanted to highlight amongst many. The first is a spreadsheet tool that we developed here at the Environmental Finance Center in North Carolina that is Plan to Pay, Scenarios to Fund Your Capital Improvement Plan. This is the tool I mentioned earlier. So you input information about your rates and revenues, you input the projects that you're looking to do, what year you want to do them, how much they'll cost, whether you want to pay cash for them or finance them through debt. And it will give you a number of important bits of information, including how your rates will need to change over time to be able to afford those capital projects. So really good tool. We talked a lot about asset management. Obviously, we have a whole series of webinars on it, but our asset management guide, Asset Management Can Work, developed as part of through Kansas Department of Health and the Environment many years ago. This is freely available to you. We'll send out the link to you if you want to get started on asset management. This is a very comprehensive guide. And a companion piece to this is a test that you can take. It's 30 questions that will show your asset management IQ. So kind of where are you starting with asset management? This is a really great place to start. And then finally, I wanted to mention EPA has developed through the years a program called CUPS, the Checkup Program for Small Systems. And this is not just a capital planning tool or an asset management tool, but really a utility management tool overall. It's free and available online, and there are a lot of good webinars you can look up to see how to use this. What we've heard from users is, to get the most out of CUPS, it's a pretty big investment of time. For our tool, you get less information, but it is a shorter amount of time in there, and then the asset management protocol is somewhere in the middle. But two things I want to mention as we're wrapping up. One is, as Savannah mentioned at the top of the hour, we have an environmental finance blog that talks about some of these topics. So we'd encourage you to sign up for that. We'll give you a chance to do that in a second here and to look at some of the resources that we have on there. And then also, we as the Environmental Finance Center Network, if you are listening in and your water system serves 10,000 or fewer people, we can provide some one-on-one help for you on capital planning or any finance and management topic.
To Glenn and Shadi, I just want to thank you for being our experts today on capital planning, and I want to thank all the attendees that joined us today. Do you have any additional closing comments at this time?
No, just to say thank you, and I think to reiterate something Shadi said earlier, please do this. Please do asset management, even a basic asset management. Please do capital planning. I can't tell you how many times I've talked to systems that have said, you know, their capital improvement plan is we wait till something breaks and then we fix it. And I think in the long term, that's not a good strategy.
Right, and we are available to assist small water systems think about this. And if we have not gotten some of the questions that you might have, please feel free to email either Glenn or me, and we'll be happy to answer your questions as well. Thank you all for your attendance.
Yeah, thank you, everybody, and we'll see you on our next webinar.